Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for informational and educational purposes only. The world of mortgages is complex, and you should always consult with a qualified professional before making any financial decisions. Your financial situation is unique, and this video is not a substitute for personalized advice. You found it. After months of searching, scrolling through endless listings, and walking through dozens of houses that just weren't the one, you finally found it. The house. The one with the backyard for the dog, the kitchen with the perfect island, in the school district you wanted. It's a feeling of pure electricity. But then a second feeling creeps in. A cold wave of anxiety that washes over the excitement. The mortgage. That single word represents the biggest financial transaction of your entire life. It's a mountain of paperwork, confusing terms, and a process so notoriously slow and painful, it's become a national punchline. And as you start your search, one name is absolutely everywhere. On TV commercials during the Super Bowl, sponsoring sports arenas, plastered all over the internet. Rocket Mortgage. They promise a revolution. Push button, get mortgage. Sounds too good to be true. Is it a high-tech dream machine that will get you into your home faster and easier than ever before? Or is it a digital trap? A faceless algorithm that sacrifices service for speed? That is the exact question we are going to answer today. By the end of this video, you will understand precisely how the biggest mortgage lender in America actually works. We're not just going to scratch the surface. We are going deep. We will pull back the curtain on their technology, break down their application process step by step, expose the hidden pros and the critical cons, and give you the unfiltered truth you need. This isn't a sales pitch. This is a field guide to navigating the Rocket Mortgage ecosystem, designed to arm you with the knowledge to decide if they are the right partner for the single biggest purchase of your life. To really understand Rocket, you have to understand where they came from, because they didn't just join the mortgage industry, they blew it up from the inside. For decades, getting a mortgage was an almost universally miserable experience. You'd get dressed up, drive to a local bank or a broker's office, and sit across a wooden desk from a loan officer. You'd hand over a literal mountain of paper. Pay stubs, tax returns, bank statements, letters of explanation for every single financial hiccup you've ever had. That loan officer would then take your mountain of paper, put it in a manila folder, and send it to an underwriter, a mysterious figure in a back office who would take days, sometimes weeks, to manually review everything. You'd wait by the phone, hoping for good news, often getting a call back asking for yet another document you had to fax over. It was slow, it was inefficient, and it was deeply intimidating. Then came a man named Dan Gilbert. In 1985, he founded a company called Rock Financial, which would later become Quicken Loans. His idea was radical for the time. What if we could do this whole thing over the phone? He cut out the stuffy bank branches and built a centralized system. But the real earthquake came with the rise of the internet. Gilbert saw the future. He realized that the entire painful paper-drenched process could be digitized. He poured hundreds of millions, then billions of dollars into building a technology platform that could automate as much of the mortgage process as humanly possible. While the old banks were still relying on fax machines and manila folders, Quicken Loans was building algorithms. They were creating a system where you could upload your documents from your couch at 10 p.m. They were building a machine. The final explosion into the public consciousness happened in 2015. Quicken Loans launched a new, streamlined, consumer-facing brand for their technology. They called it Rocket Mortgage, and they unveiled it to the world with a Super Bowl commercial. The message was brutally simple and effective. The intimidating, complex process of getting a mortgage could now be as easy as ordering a pizza online. America was listening. The idea of getting a home loan on your phone seemed like science fiction, but it tapped into a deep frustration that millions of homebuyers felt. In just a few short years, they rocketed past giants like Wells Fargo and Chase to become the #1 mortgage lender in the United States by volume. They didn't just build a better mortgage company. They fundamentally changed the expectations of the American homebuyer. Think about that name for a second. Rocket. It's not an accident. It's a promise. What does a rocket imply? Speed, power, advanced technology. It suggests a journey that is fast, direct, and gets you to your destination with incredible efficiency. It's the polar opposite of the old way, which felt more like crawling through mud. The entire brand is built on this one powerful idea. We have replaced the slow human gate-kept process with a fast, intelligent, technological one. We've taken the friction out of the biggest financial transaction of your life. This promise is the engine of their growth, and it's what we're here to put to the test. Does the reality live up to the name? So, what exactly is the problem Rocket Mortgage claims to have solved? It's the information bottleneck. In a traditional mortgage, you are the delivery person for your own financial data. You have to gather bank statements from your bank, pull pay stubs from your employer's HR portal, and dig up tax returns from your accountant or a dusty file cabinet. You then physically or digitally deliver all of this to the lender. Rocket's core innovation was to say, what if we could just connect directly to the source? What if, with your secure permission, we could plug directly into your bank to verify your assets? What if we could connect to your payroll provider to instantly verify your income and employment? By creating these digital handshakes between financial institutions, they aim to eliminate you, the borrower, as the middleman. This is the central pillar of their push-button, Get Mortgage philosophy. It's about creating a seamless flow of data that allows their algorithm to make a decision in minutes, not weeks. It's about verifying your financial life with a click, instead of a crate of paper. This technological advantage is what allows them to operate at a scale that is simply staggering. They are a volume machine. While a traditional loan officer might handle a few dozen loans a year, Rocket's system processes thousands upon thousands every single day. But this raises the most important questions for you, the homebuyer. Does that speed come at a cost? When you replace a human at a desk with an algorithm in the cloud, what do you gain, and more importantly, what might you lose? Is their process truly as simple as they claim? Or are there hidden complexities? And is their loan the best deal for you? Or are you paying a premium for the convenience? So, how do they actually do it? What really happens when you go to their website or open their app and click that big, inviting Start Your Application button? Let's peel back the curtain and walk through the Rocket Mortgage machine step by step, starting with the very first click. That first click is less of a bang and more of a quiet digital handshake. You're not immediately hit with a 20-page legal document. Instead, you're greeted by a clean, minimalist interface that asks a simple question. Something like, what are you looking to do? Buy a home? Refinance? It's designed to feel less like a mortgage application and more like a friendly conversation. You select Buy a Home, and the machine whirs to life. The first thing the system needs to know is who you are. Not in a philosophical sense, but in a can we run a credit check sense. So you'll enter the basics. Your name, your address, your date of birth. This is standard stuff. But then comes the first moment of truth for many applicants, your social security number. This is the key that unlocks your entire financial history. Without it, the lender is flying blind. Handing over your SSN online can feel unnerving. But in the world of lending, it's the non-negotiable price of admission. This is how they access your credit report and, most importantly, your credit score. Rocket Mortgage knows this is a sensitive step, so they frame it with layers of security assurances. But make no mistake, this is the first major gate you have to pass through. Once you've provided the key, the system needs to understand your power. Your financial power. This means talking about money. It will ask you about your income. Where do you work? How long have you been there? How much do you make? This isn't just about your salary. The system wants to know about bonuses, commissions, overtime, or any side hustle income. For a traditional W-2 employee, this is pretty straightforward. You'll likely input your gross annual salary, and the system does the math. But here's where the digital process really shines compared to the old way of doing things. In the past, you'd be gathering stacks of paper, pay stubs, W-2s, tax returns from the last 2 years, and physically handing them to a loan officer. Rocket's system streamlines this. It will often ask for your permission to digitally link to your employer's payroll provider or to your bank accounts. This is a huge part of their push-button magic. By granting this access, you allow their system to automatically verify your income and your assets without you having to upload a single PDF. It just pulls the data directly, securely, and instantly. You're trading a bit of privacy for a massive amount of convenience and speed. So at this point, Rocket's algorithm has 2 critical pieces of information about you. Your identity via your social security number, and your income and assets, hopefully verified digitally. Now it performs its first truly rocket speed maneuver, the soft credit pull. This is a term you hear all the time, but what does it actually mean? Think of it this way. A hard credit pull, the kind that can ding your credit score, is like formally applying for a seat at an exclusive restaurant. The reservation goes on your record. A soft credit pull is like peeking at the menu through the window. You get all the information you need to see if you can afford it, but nobody inside even knows you were there. It leaves no trace on your credit report, and has zero impact on your score. In the fraction of a second after you grant permission, Rocket's system sends a request to the major credit bureaus, Experian, TransUnion, and Equifax. It gets back a snapshot of your financial life, your credit score, your outstanding debts like car loans, student loans, and credit card balances. Now the real computation begins. The system takes the two sides of your financial equation, the money coming in, your income, and the money going out, your existing debts, and calculates the single most important number in mortgage pre-approval, your debt-to-income ratio, or DTI. This ratio is the bedrock of modern lending. It's a simple percentage that tells lenders how much of your monthly income is already spoken for by debt. Let's break it down with a simple example. Say you earn $6,000 a month before taxes. That's your gross monthly income. Now let's add up your monthly debt payments. You have a $500 car payment, a $300 student loan payment, and let's say a minimum credit card payment of $100. Your total monthly debt is $900. The system divides that $900 by your $6,000 income. The result is 0.15, or a 15% DTI. This number is everything. Lenders have very specific DTI thresholds they cannot cross. Generally, for a conventional loan, they want to see a DTI, including your future mortgage payment, of no more than 43%. Some government-backed loans might stretch to 50% or even higher in special cases, but 43% is the magic number for most. So Rocket's algorithm has your income, your current debts from the soft credit pull, and it knows the maximum DTI limit. With this, it can work backward to figure out the maximum possible monthly mortgage payment you could theoretically afford. From that monthly payment, it can then calculate the total loan amount you could be approved for, based on current interest rates. But it's not just a simple calculator. This is all happening inside what's known as an automated underwriting system, or AUS. This is the brain behind the operation. Rocket Mortgage has built a beautiful, user-friendly interface, but underneath, it's plugging into the same powerful decision engines that the entire mortgage industry uses. The two giants in this space are Fannie Mae's system, called Desktop Underwriter or DU, and Freddie Mac's, called Loan Product Advisor or LPA. When you enter your information into Rocket, it's being fed into these colossal billion-dollar systems. The AUS doesn't just look at your DTI. It analyzes your entire profile in seconds. It looks at your credit score. Is it above the minimum of, say, 620? It looks at your credit history. Do you have a history of late payments, bankruptcies, or foreclosures? It looks at your employment history. Have you had a stable job for the last 2 years? It cross-references thousands of data points against a complex set of rules and risk models that have been refined over decades. The US is looking for a story. Does this person's financial story fit the profile of a reliable borrower? It's cold, it's calculating, and it's incredibly fast. While a human underwriter might take days to review all these documents and make a judgment call, the AUS delivers a verdict in seconds. And that verdict comes back to you through Rocket's interface in the form of a pre-qualification. This is the first major payoff for the user. After just a few minutes of entering information, you get a number. A big number. Congratulations, you're pre-qualified for up to $400,000. Feels momentous. Feels real. And you can immediately download a pre-qualification letter. This letter is your ticket to the next stage of the home buying game. It's the document you showed to real estate agents to prove you're a serious buyer, not just a window shopper. But it is absolutely critical to understand what this pre-qualification is, and what it isn't. It is a powerful estimate based on the unverified information you provided and a quick look at your credit. It is a fantastic starting point that gives you a realistic budget for your house hunt. What it is not is a guarantee of a loan. The system has taken you at your word. It has assumed the income you typed in is accurate. It has assumed the bank account information is correct. It's a conditional approval based on the idea that everything you've told it so far will check out. The real verification, the deep dive into your financial life, is still to come. Rocket calls this next step a verified approval, and it's a much more intensive process. But they've designed their system to get you this initial powerful pre-qualification first, to get you motivated, to get you hooked, and to get you out the door and looking at houses. They've given you the green light, but the race has just begun. The next step is to prove you actually have the horsepower you claimed you did. This is the proving ground. It's where the promises you made on that slick, easy-to-use online application meet the cold, hard reality of financial documentation. This is the stage where excitement can turn into frustration, and where many aspiring homeowners get bogged down in a swamp of paperwork. But it's also the most critical step in transforming that pre-qualified approval into a verified approval. The golden ticket that tells a seller you're not just a dreamer, you're a serious buyer with the financial muscle to back it up. So what exactly is happening here? Rocket Mortgage, and any lender for that matter, is now legally and financially obligated to verify every single number you entered. Think of it this way: the initial application was you telling them your story. This part is you providing the evidence, the footnotes, the bibliography that proves your story is true. They're not doing this to be difficult. They're doing it because of a little thing called the ability to repay rule, a post-2008 financial crisis regulation that says lenders have to make a good faith effort to ensure you can actually afford the loan they're giving you. They need to build a case file on you that proves to their investors, to regulators, and to their own risk department that you are a good bet. Your job is to make it impossible for them to say no. And you do that by providing them with exactly what they need, exactly when they need it. This is the document collection phase, and Rocket has poured millions into making their technology streamline this process. You'll be living inside their secure online portal. It's your new best friend and, at times, your most demanding taskmaster. The system is designed to be a checklist. As you complete one task, another might pop up. It's dynamic. Let's break down the core 4 pillars of documentation they are going to demand. First, and most importantly, is proof of income. This is the engine of your financial profile. They need to know with certainty how much money is coming in. If you're a W-2 employee, meaning you get a regular paycheck from an employer, this is relatively straightforward. They'll ask for your most recent pay stubs, usually covering the last 30 days. They'll want to see your name, the employer's name, your pay rate, and your year-to-date earnings. This confirms your current employment and income. Then they'll ask for the last 2 years of your W-2 forms. Why 2 years? They're looking for stability. A 2-year history shows them that your income isn't a recent fluke. It demonstrates a consistent earning pattern. They will also likely ask for your last 2 years of federal tax returns, all pages. They'll compare your W-2s to what you filed with the IRS to make sure everything lines up. If you have overtime, bonuses, or commission income, this is where it gets scrutinized. They need to see a 2-year history of you receiving that extra income consistently to be able to count it toward your qualification. A one-time big bonus from last Christmas? They'll probably ignore it. A steady, predictable quarterly bonus for 8 straight quarters? Now you're talking. Now, if you're self-employed, a freelancer, or a small business owner, get ready. Your journey is more complex. You don't have W-2s, so your tax returns become the holy grail. They will want the last 2 years of your personal and your business tax returns, including all schedules, especially the Schedule C for sole proprietors or K-1s for partnerships. They will also likely ask for a year-to-date profit and loss statement, or P&L, and a balance sheet for your business. What they're doing is averaging your net income. That's your income after all your business expenses and write-offs over the last 24 months. This is a huge stumbling block for many entrepreneurs. You may have grossed $200,000, but if you wrote off $150,000 in expenses to lower your tax bill, the lender only sees an income of $50,000. The second pillar is proof of assets. This is your fuel tank. This is the cash you have for the down payment, for closing costs, and the reserves you'll have left over after the deal is done. They need to see where this money is coming from. You'll be asked to provide the last 2 months of statements for every single account you plan to use funds from. That means checking accounts, savings accounts, money market accounts, investment accounts, for 401ks, you name it. And here's where Rocket's tech comes into play. They will heavily encourage you to link your bank accounts directly to their system. This allows their software to securely pull your transaction data automatically. For many, this is a huge time saver. No more downloading, printing, scanning, and uploading dozens of pages of bank statements. However, if you're not comfortable with that, you can always upload the documents manually. But be warned, they will scrutinize every single page. They need all the pages, even the blank ones that say, "This page intentionally left blank." If your statement is 8 pages long, you upload 8 pages. They are looking for 2 things here: the total amount of money and the source of that money. This is critical. Any large, non-payroll deposit will raise a giant red flag. Did your grandma give you $10,000 for your down payment? That's wonderful, but to the lender, it's a mysterious chunk of cash that could be an undisclosed loan. You will need to paper trail it. This means providing a signed gift letter from your grandma stating the money is a true gift and not a loan that needs to be repaid. And you'll also need to show the money leaving her account and entering yours. Selling a car for cash and depositing it? You'll need a bill of sale and a copy of the title. This process, called sourcing funds, feels invasive, but it's a non-negotiable part of the anti-money laundering laws that all banks must follow. The third pillar is your debts and liabilities. They've already pulled your credit report, so they have a good idea of your monthly obligations, car loans, student loans, credit card payments. But they need to verify anything that might be missing or unclear. Do you have a divorce decree that requires you to pay alimony or child support? They need the full document. Are you co-signed on a loan for your kid's car? Even if your kid makes the payment every month, that debt legally belongs to you, and they will count it against your income unless you can provide 12 months of bank statements from your kid proving they are the one making the payments. Finally, the fourth pillar is simple: proof of identity. A clear copy of your driver's license or other government-issued photo ID. They just need to confirm you are who you say you are. As you upload these documents into the Rocket portal, a team of specialists, sometimes called processors or Rocket professional experts, reviews them. Their job is to assemble your file perfectly before it goes to the final boss, the underwriter. They will be the ones emailing or calling you saying, "Hey, we see a deposit for $2,500 on your April statement. Can you tell us where that came from?" Or, "Page 3 of your bank statement is missing. Can you please re-upload the full document?" My advice during this phase is simple. Be an open book and be fast. Respond to their requests immediately. The speed of your mortgage approval is now almost entirely in your hands. Every day you delay getting them a document is another day you're not getting your final approval. And now for the cardinal rule, the one commandment of the mortgage process you must not break. Once this process starts, your financial life is frozen in carbonite. Do not make any large purchases. Do not finance a new car or a living room full of furniture. Do not co-sign a loan for anyone. Do not open new credit cards. Do not quit your job or change jobs without talking to your lender first. And do not move money around between accounts without a clear paper trail. I once saw a deal completely fall apart 1 week before closing because the buyer went out and bought a brand new $60,000 pickup truck. He thought he was already approved, but the lender does a final credit check right before funding. They saw the new $900 a month payment, and it completely destroyed his debt-to-income ratio. The loan was denied. He lost the house and he lost his earnest money deposit. Don't be that guy. You are now in a quiet period. Your only job is to work, save money, and feed the document-hungry machine at Rocket Mortgage. You methodically upload every pay stub, every bank statement, every tax form they ask for. You answer their questions, you source your deposits, and you wait. Eventually, you'll see the status in your portal change. All the checklist items will be green. Your file is now complete. It has been packaged, organized, and verified. And now, it's being sent on to the one person who holds the final power of approval or denial. It's going to the underwriter. Think of the underwriter as the final boss in a video game. Your mortgage banker and processor are your teammates who've helped you gather all the power-ups and special items. They've coached you, guided you, and made sure your inventory is perfect. But now you have to face the final challenge alone. The underwriter is the ultimate gatekeeper, the guardian of the lender's money. Their one and only job is to protect the lender from making a bad investment. And that bad investment is you. It sounds harsh, but it's the truth. They aren't your friend. They don't know your dreams of painting the living room a certain color or setting up a swing set in the backyard. They are a financial detective, a risk analyst, and their entire focus is on one question. If we lend this person hundreds of thousands of dollars, what is the statistical probability that they will pay it back on time every single month for the next 30 years? To answer that question, they meticulously examine your file through the lens of what the industry calls the 3 C's of underwriting. This is the holy trinity of mortgage approval: capacity, credit, and collateral. Every single document you've submitted, every number on your application, it all gets sorted into one of these 3 buckets. Let's start with the first C, capacity. This is the simplest, most brutal question. Can you actually afford this house? It's not about whether you feel like you can make the payments. It's about what the cold, hard numbers say. The primary tool they use here is your debt-to-income ratio, or DTI. We've talked about this, but now the underwriter is verifying it with a fine-tooth comb. They take your proposed new mortgage payment, including taxes, insurance, and any HOA fees, and add it to all your other monthly debt payments, your car loan, your student loans, your credit card minimums. Then they divide that total by your gross monthly income, the money you make before taxes. They are scrutinizing your income sources with extreme prejudice. If you're a salaried W-2 employee with the same company for 10 years, that's a green flag. Your income is stable and predictable. But if you're a freelancer, or you rely heavily on commissions or bonuses, they're going to dig deeper. They'll want to see a 2-year history to average it out. They need to be convinced that your income isn't a fluke. They're looking at your employment history. Have you been hopping jobs every 6 months? That might be a red flag. They're building a picture of your financial stability, your capacity to consistently earn enough to handle this new massive debt. Next up, the second C, credit. This is all about your track record. Your credit score is the headline, but the underwriter reads the entire article. They are looking at your history of borrowing money and, more importantly, your history of paying it back. Do you pay your bills on time? Every time? A single 30-day late payment on a car loan from 2 years ago might not be a deal killer, but it's a blemish they will absolutely note. Multiple late payments? That's a huge red flag. They're looking at how much credit you're using. Are all your credit cards maxed out? That suggests you might be living beyond your means, relying on debt to get by. That's a risk. They're also looking for major negative events. Bankruptcies, foreclosures, collections. These are the scarlet letters of the credit world, and while they don't automatically disqualify you, they require heavy documentation, explanation, and usually, a significant waiting period. The underwriter is asking, does this person have a demonstrated history of being a responsible borrower? Your past behavior is their best predictor of your future performance. And finally, the third C, collateral. This is the one C that has nothing to do with you. It's all about the house. The lender is giving you a mountain of cash, but they aren't just doing it on a handshake. They are securing the loan against the property itself. If you stop paying, they take the house. That's the deal. So the underwriter needs to be certain that the house is actually worth the amount of money they're lending. How do they do that? Through the appraisal. The lender hires an independent, third-party appraiser to go out to the property. This appraiser inspects the home, measures it, notes its features and condition, and compares it to similar homes that have recently sold in the same neighborhood. Their final report gives an expert opinion of the home's current market value. The underwriter will scrutinize this report. If you're borrowing $300,000, they need that appraisal to come in at $300,000 or more. If it comes in low, the entire deal can fall apart. The collateral has to be sufficient to cover the loan. Now, this is where Rocket Mortgage's technology really flexes its muscles. In a traditional bank, a human underwriter manually goes through every single page of your file, line by line. It can take days, even weeks. Rocket, on the other hand, has a powerful automated underwriting system, or AUS. This system is the engine inside the Rocket. It can digitally verify your income with your employer, pull asset statements directly from your bank, and analyze your credit report against thousands of data points and lending guidelines in a matter of minutes. This system does the initial heavy lifting. It can analyze the 3 C's and make a preliminary decision based on the data. This is why you can get that pre-qualified approval so quickly. The system flags your file as highly likely to be approved. However, and this is a critical point, the algorithm doesn't make the final decision. There is still a human underwriter. Their job is to review the automated findings, look at any complexities the system flagged, and give the final human sign-off. The technology makes the process exponentially faster and more efficient, but the final responsibility still rests with a person. So your file is with this person, and you're waiting. This waiting period, whether it's a few hours with Rocket or a few weeks with a traditional lender, is one of the most stressful parts of buying a home. And it is during this exact period that you can make a catastrophic mistake. So listen closely. While your loan is in underwriting, your financial life needs to be frozen in carbonite. You must live by these commandments. 1. Thou shalt not make any large purchases. Do not go out and finance furniture for your new house. Do not buy a new car. I don't care if the dealership is offering 0% interest for 84 months. Any new debt will change your DTI ratio, and the underwriter will see it. They do a final credit check right before closing, and a new car loan appearing out of nowhere can absolutely get your loan denied at the last second. 2. Thou shalt not change jobs. Even if it's a better job with a higher salary, it introduces a new variable. Underwriters hate variables. They want stability. A new job means a new probationary period, a change in pay structure, and uncertainty. Wait until after you have the keys to the house in your hand. 3. Thou shalt not open or close any lines of credit. Don't apply for a new credit card to get the sign-up bonus. Don't close an old credit card you never use, thinking it'll clean up your credit. Closing an account can actually lower your credit score by reducing your overall available credit. Just leave everything exactly as it is. And 4. Thou shalt not make large, undocumented cash deposits into your bank account. If your grandma gives you $5,000 in cash for a housewarming gift, that's wonderful. But if you just deposit it, the underwriter will see it and freak out. To them, that's mattress money with no source. It could be an undisclosed loan from a friend, which would count as a debt. Any large deposit needs to be sourced and paper trailed. After the underwriter has finished their review, one of 3 things will happen. The first is the dream scenario. Approved as submitted. You get the email or the call. It's a clear to close. This means the underwriter found no issues, your file is perfect, and you are fully approved to move forward to closing. Champagne bottles get popped. This is the goal. The second is the nightmare scenario. Denial. The underwriter has found a fatal flaw in your file. Maybe your DTI is just too high. Maybe a previously undiscovered collection account popped up. Maybe your income couldn't be properly verified. A denial is heartbreaking, but it happens. But the third outcome is by far the most common. It's not a yes and it's not a no. It's a yes, but this is called a conditional approval. The underwriter is saying, I am prepared to approve this loan if you can provide me with a few more things. These are called conditions. A condition could be simple, like a letter of explanation for a large withdrawal from your savings account last month. It could be more complex, like needing the most recent pay stub from your new job to verify a raise. Or it could be the biggest condition of all. The loan is approved, pending a satisfactory appraisal of the property. Getting that list of conditions can feel like a setback, but it's actually great news. It's the underwriter showing you their cards. They've laid out the exact final roadmap to a clear to close. All you have to do is navigate it. But what happens when those conditions are tricky? How do you write a letter of explanation that satisfies a skeptical underwriter? And what on earth do you do if that all-important appraisal comes back with a number that threatens to sink your entire home buying dream? Let's tackle that last question first, because it's the one that causes the most sleepless nights. The appraisal. You found the home. The seller accepted your offer. You're picking out paint colors in your mind, and then you get the call. The appraisal came in low. Your heart sinks. It feels like the entire deal is about to implode. This single number, generated by a third-party professional you've never met, holds the power to make or break your purchase. So what happens now? First, let's understand why this is such a big deal. The appraisal isn't for you. It's for the lender. In this case, it's for Rocket Mortgage. They are about to give you hundreds of thousands of dollars, and the house is their collateral. It's their insurance policy. If for some reason you stop making payments, they need to know that they can sell the house and get their money back. So they will never ever lend you more money than the house is officially worth. If you agreed to pay $400,000, but the appraiser says it's only worth $380,000, Rocket Mortgage will only base the loan on that $380,000 value. That $20,000 gap becomes your problem. When your loan is in underwriting with Rocket, they order the appraisal through what's called an appraisal management company, or an AMC. This is required by federal law to create a firewall. Neither you, your agent, nor your loan officer at Rocket can directly choose, contact, or pressure the appraiser. It ensures an unbiased, fair market valuation based on cold, hard facts. The appraiser will visit the property, measure it, note its features and condition, and then compare it to recently sold homes in the immediate area. These are the comps, or comparables, and they are the most critical part of the report. So, what do you do when that report comes back with a number lower than your purchase price? You have 4 main paths forward. Path number 1. You can challenge the appraisal. This is officially called a reconsideration of value. You can't just say, I think you're wrong. You and your real estate agent need to build a case. Did the appraiser miss a key feature, like a brand new roof or a fully renovated basement? Did they use poor comparable sales? Maybe they compared your beautifully updated 3-bedroom colonial to a fixer-upper down the street that sold 6 months ago. Your agent can provide a list of better, more recent, more accurate comps to the lender. Rocket will submit this package back to the AMC, and the appraiser will review it. Sometimes they adjust the value. Sometimes they don't. It's not a guarantee, but it's your first and best shot. Path number 2. You renegotiate with the seller. This is where a great real estate agent earns their commission. They go back to the seller and lay out the facts. Look, they'll say, the house appraised for $380,000. My buyer's lender won't finance the $400,000 price. You can lower the price to meet the appraisal, or we might have to walk away. And keep in mind, the next buyer who needs a mortgage is probably going to run into this exact same appraisal issue. A motivated seller who doesn't want to put their house back on the market will often agree to lower the price. Path number 3, the most painful one, you come up with a difference in cash. If the seller won't budge and the appraisal value is firm, you can choose to pay that $20,000 gap out of your own pocket, on top of your existing down payment and closing costs. For some buyers in a competitive market who are desperate for the house, this is the only way. But it's a huge financial hit and effectively means you are instantly underwater on your home, owing more than its current market value. And finally, path number 4. You walk away. Your purchase agreement almost certainly has an appraisal contingency. This is your legal escape hatch. It says that if the home doesn't appraise for the purchase price, you can cancel the contract and get your earnest money deposit back. It's heartbreaking to get so close and have to start over, but it's a safety net designed to protect you from massively overpaying for a property. Now let's rewind a bit. While the appraisal is happening, the underwriter is still working on your file, and they might come back with other conditions. This brings us to the letter of explanation, or LOX. It sounds intimidating, but it's usually very simple. An underwriter is a detective, and their job is to make sure your financial story has no plot holes. If they see something that doesn't make sense, they'll ask for an explanation. Let's say you have a large, unusual deposit in your bank account for $15,000 that showed up 2 months ago. To the underwriter, that's a red flag. Is it a loan from a relative that you didn't disclose? An undeclared source of income? They need to know because an undisclosed loan affects your debt-to-income ratio. So they'll issue a condition. Provide a letter of explanation for the $15,000 deposit. Writing a good LOX is an art form in its simplicity. Do not write a novel. Do not get defensive. Be clear, concise, and factual. A perfect letter would read something like this. To whom it may concern, the $15,000 deposit into my checking account on March 5th was a cash gift from my father, Bob Smith, to assist with the down payment on my home. It is not a loan and there is no expectation of repayment. A signed gift letter from my father is also attached for your records. Sincerely, you. That's it. Short, sweet, and it gives the underwriter exactly what they need to check that box and move on. You might be asked for unlocks for other things too. Maybe you had a gap in your employment history a year ago. You'll write a letter explaining you were traveling or taking care of a family member. Maybe you have a late payment on a credit card from 2 years back. You'll write a quick letter explaining the circumstances. The key is to be honest and direct. The underwriter isn't trying to deny your loan. They're trying to build a file that justifies approving it. Your job is to give them the tools to do that. Beyond the LOX and the appraisal, you might get a few other simple conditions. They might ask for your most recent pay stub or bank statement if the ones you submitted are now more than 30 days old. They will do a final verification of employment, often calling your HR department a day or two before closing just to confirm you still work there. It's all part of the final double check. You work with your Rocket Mortgage team, you track these conditions in the online portal, you upload the requested documents, you get the appraisal back, and you navigate any issues. One by one, you knock down every condition the underwriter has set. And then you get the 3 most beautiful words in the entire home buying process. Clear. To close. This is the moment. This is the finish line of the mortgage marathon. Clear to close, or CTC, means the underwriter has signed off. They have reviewed your income, your assets, your credit, the appraisal, the title report, everything. They are fully satisfied. They have stamped your file with their final approval. Rocket Mortgage is now officially committed to funding your loan. The money is ready. The dream is real. When you get that CTC notification, it's time to celebrate. But don't pop the champagne just yet, because getting the green light triggers the final, and often most confusing, phase of the entire journey. The closing itself. You're about to be introduced to a document called the closing disclosure. It's a 5-page breakdown of every single dollar involved in your transaction, and you only have 3 days by law to review it. What exactly is in this document? What are you looking for? And what are all these closing costs like origination fees, title insurance, and escrow prepayments that can add up to thousands of dollars you weren't expecting? Let's break it down. That 5-page document is called the closing disclosure, or the CD. And it is, without a doubt, one of the most important documents you will ever sign. It's the final itemized bill for your home loan. The numbers on this page are not estimates anymore. This is the real deal. This is the final exam. And that 3-day review period isn't just a friendly suggestion. It's a federal law designed to protect you, to give you the power to stand your ground and say, wait a minute, this isn't what we agreed to. Your mission during these 3 days is simple, but it is critical. You need to become a financial detective. Your primary tool? The loan estimate you received earlier. You're going to place these two documents side by side, either physically on your kitchen table or digitally on your screen, and you're going to compare them line by line. With Rocket Mortgage, their online portal makes this easier, often highlighting any changes for you. But you still need to be the final inspector. You are the last line of defense for your own wallet. Let's start with page 1 of the closing disclosure. This is your summary, the 30,000-foot view. At the very top, you'll see the loan terms. Is the loan amount what you expected? Is the interest rate exactly the rate you locked in? Is the monthly principal and interest payment the same? If any of these 3 core numbers are different from your loan estimate, you need to stop and call your lender immediately. These are the foundational pillars of your mortgage. They should not change without a very clear reason that you've already discussed and approved. Next, look at the projected payments section. This breaks down your total monthly payment, often referred to as PITI, principal, interest, taxes, and insurance. Think of it as the 4 key ingredients in your monthly payment recipe. The principal and interest are fixed for the life of your loan, if you have a fixed-rate mortgage. But the taxes and insurance portion can and likely will change over time. This section will show you how much is being collected for your escrow account each month. We'll dive deeper into escrow, but for now, just make sure these numbers look reasonable and match your estimate. Finally, on page 1, you'll see the big one: costs at closing. This section gives you 2 crucial numbers. The first is closing costs, which is the grand total of all the fees required to finalize the loan. The second, and the number you really care about, is cash to close. This is the exact amount of money you need to have ready on closing day. This is the number you'll be wiring or bringing as a cashier's check. Why is it different from your down payment? Because it includes your down payment, but then adds all those closing costs and subtracts any deposits you've already made, like your earnest money. Now for the part that trips everyone up, page 2. This is the nitty-gritty, the detailed breakdown of every single closing cost. It's organized into sections, and understanding them is key. Section A is origination charges. These are the fees your lender, in this case Rocket Mortgage, charges for creating the loan. This is how they get paid. You might see an application fee, an underwriting fee, and something called points. Let's demystify points. 1 point is equal to 1% of your loan amount. So on a $300,000 loan, 1 point costs $3,000. Why would you pay this? You pay points to buy down your interest rate. It's essentially prepaid interest. You're paying more upfront to have a lower monthly payment for the next 30 years. Whether this is a good deal depends entirely on how long you plan to stay in the home. You have to calculate the break-even point. If paying that $3,000 saves you $50 a month, it'll take 60 months or 5 years just to break even. If you plan on moving in 3 years, you've lost money. If you plan on staying for 20, you've made a great deal. The key is to make sure any points listed here are points you explicitly agreed to pay. Next is Section B, services you could not shop for. These are third-party fees for services the lender requires, and they choose the provider. Think of the appraisal fee, the credit report fee, or a flood certification fee. By law, the total of these fees cannot be more than 10% higher than what was on your loan estimate. But in reality, they should be almost identical. Check them. Section C is where you have some power. Services you could shop for. These are required services, but you had the right to choose the provider. The most significant one here is title insurance. This is a big one, often costing thousands of dollars, and it's wildly misunderstood. Think of title insurance like a background check for the property's history. A title company scours public records to make sure the seller truly has the right to sell you the house, and that there are no hidden claims, liens from unpaid contractors, or long-lost heirs who could show up and claim the property is theirs. You'll likely see 2 title policies listed. Lender's title insurance is mandatory. It protects the lender's investment in your property, not you. Owner's title insurance is technically optional, but you should almost never ever waive it. It's a one-time fee paid at closing that protects you, the owner, from any of those historical claims for as long as you own the home. It's your shield against the ghosts of the property's past. Make sure you understand these charges, and that they match the quote from the title company you chose. The other sections on page 2 cover things like government recording charges. the fee your local county charges to officially record you as the new owner, and prepaids. Prepaids are things you have to pay for in advance, like your first year of homeowner's insurance premiums and prepaid daily interest on the mortgage from the day you close to the end of the month. Now let's flip to page 3. This page is the master calculation. It's the summary that shows how they arrived at that final cash to close number. It starts with the sale price of the home, then it adds in all your closing costs from page 2. After that, it starts subtracting all the money you've already contributed or that others are contributing for you. This is where you'll see a credit for your earnest money deposit. If the seller agreed to pay for some of your closing costs, you'll see that credit here. The final number at the bottom of this page should match the cash to close on page 1. Go through this page with a fine-tooth comb. This is the final receipt before the big purchase. You need to understand where every single dollar is going. Pages 4 and 5 are the fine print. Page 4 gives you important details about your loan, like a confirmation of your escrow account and what it will pay for. It also outlines what happens if you make a late payment. Page 5 provides loan calculations like the annual percentage rate, or APR, and other disclosures. You should absolutely read these pages, but your most intense detective work needs to happen on pages 1, 2, and 3. Those are the pages where costly errors are most likely to hide. Remember, the purpose of this 3-day review is to find discrepancies and ask questions. Don't be shy. This is potentially the largest financial transaction of your life. Call your loan officer. Email them. Point to a specific line number and ask, "What is this charge for?" Or, "Why is this number different from my loan estimate?" A good lender will be able to explain every single line item to your satisfaction. You've decoded the document, you've verified the numbers, and you've given your lender the green light. Now you're in the final stretch. The finish line is in sight. But this is also where some of the most nerve-wracking steps happen. What is the clear to close? How do you safely wire tens or even hundreds of thousands of dollars without falling victim to increasingly sophisticated wire fraud scams? And what is the single most important thing you must do in the 24 hours before you finally get the keys to your new home? It's the homebuyer's worst nightmare. Imagine this: you've done everything right. You saved for years, you found the perfect home, you navigated the inspections and the appraisal, and you've been cleared to close. You're just days away from getting the keys. Then an email arrives. It looks official. It's from your title company, or maybe even someone pretending to be from Rocket Mortgage. It has the logo, the correct names, the property address, and it has the wiring instructions for your down payment and closing costs. It's a huge amount of money, your entire life savings. You follow the instructions carefully, go to the bank and send the wire. You feel a huge sense of relief. You did it. Except you didn't. The email was fake. The account number was for a scammer's offshore account. And your money? It's gone. Vanished in an instant, likely never to be recovered. Your dream of homeownership evaporates, replaced by a devastating financial black hole. This isn't a scare tactic. It's a tragic reality for thousands of American families every single year. Real estate transactions are the #1 target for wire fraud because the dollar amounts are so high and the timeline is so sensitive. Scammers know you're stressed, you're juggling a dozen things, and you're eager to get the deal done. They exploit that vulnerability with terrifying precision. So, how do you protect yourself? How do you ensure your money, the largest sum you will likely ever transfer, gets to the right place? The answer involves a level of paranoia that might feel excessive, but is absolutely necessary. First, understand the key document, the closing disclosure or CD. A few days before your scheduled closing, you will receive this standardized 5-page form from Rocket Mortgage. It's the final official breakdown of your loan. It details your interest rate, your monthly payment, and, most importantly, the exact amount of money you need to bring to closing. By law, you must receive this document at least 3 business days before you sign your final paperwork. This is your cooling-off period to review everything. This document is your financial North Star for the closing. The number on that CD, the cash-to-close amount, is what you'll be wiring. Now for the instructions themselves. This is the moment of maximum danger. You will receive wiring instructions from the title or escrow company, the neutral third party handling the funds. These instructions will almost certainly arrive via email. Here is the single most important rule, and I want you to burn this into your brain. Never ever trust wiring instructions sent via email. Period. Do not trust them. Do not click any links in that email. Do not call any phone number listed in that email. Scammers are masters of disguise. They can create emails that are indistinguishable from the real thing. They can even hack into a real estate agent's or a title company's email account and send you fraudulent instructions from a legitimate address. So what do? You verify. But you have to verify the right way. Before you even get to this stage, weeks before, if possible, you need to have independently sourced the direct phone number for your contact at the title company. Get it from your real estate agent in person or over the phone at the beginning of the process. Write it down. Put it in your phone. This is your trusted number. When you receive the email with the wiring instructions, do not reply. Do not call the number in the email signature. Instead, pick up your phone and call that trusted number you saved weeks ago. When you get your contact on the line, you are going to verbally confirm every single digit of the routing number and the account number. Read it to them from the instructions you received, and have them read it back to you from their system. Confirm the name on the account and the exact dollar amount. It might feel awkward. You might feel like you're being difficult. Do it anyway. Any legitimate professional will understand and appreciate your diligence. In fact, if they seem annoyed or try to rush you, that's a massive red flag. Once you have verbally confirmed the details over a trusted phone line, you go to your bank. Do not initiate the wire transfer online. Go to a physical branch and do it in person with a banker. Bring the printed instructions with you. Before they hit send, have the banker read the account number and routing number back to you one last time. Double-check it against the information you verbally verified. It's this multi-layered, slightly paranoid process that stands between you and financial ruin. Rocket Mortgage provides the loan, but your down payment is your responsibility to protect. Treat it like the treasure it is. Okay, you've successfully and safely wired the funds. The money is sitting with the title company, ready for closing day. But you're not done yet. There is one more critical mission you must complete in the final 24 to 48 hours. The final walkthrough. This is not a casual stroll through your soon-to-be home. This is your last chance to ensure the property is in the condition you agreed to buy it in. Once you sign those closing papers, the house and all its problems become yours. There are no takebacks. Your real estate agent will schedule this with you. Your goal is to verify two main things: that all negotiated repairs have been completed, and that no new damage has occurred since your last visit. Remember that inspection report? Where the seller agreed to fix the leaky faucet under the sink and repair the broken window pane. Now is the time to check. Bring your inspection report summary with you. Turn on that faucet. Look under the sink. Make sure that window is fixed properly, not just patched with duct tape. If the repairs aren't done or aren't done correctly, you need to know before you sign. Next, you're checking for new damage. Moving is chaotic. Sellers might have scraped the walls moving a couch, dented the brand new stainless steel fridge, or cracked a floor tile dropping a heavy box. You are looking for any issues that were not there during your inspection. You also need to verify what stays and what goes. Your purchase agreement is very specific about inclusions and exclusions. If the contract says the washer and dryer are included, you need to make sure they are still there. If it says the seller is taking the custom dining room chandelier, you need to make sure there isn't a hole in the ceiling with exposed wires. Finally, do a systems check. Run the heat and the air conditioning for a few minutes, even if it's the wrong season. You're not doing a full inspection, just confirming they turn on. Run the hot water in the sinks and showers. Flush all the toilets. Turn on every light switch. Test the garage door opener. Open and close windows and doors. You'd be amazed what can happen in the weeks between inspection and closing. Pipe could have started leaking. An electrical outlet could have shorted out. What if you find something wrong? A big scratch on the hardwood floors? The promised repairs left undone? You don't panic and you don't refuse to close. You immediately call your agent, right there from the property. Your agent will contact the seller's agent, and you'll negotiate a solution. This usually doesn't derail the closing. Often, the seller will agree to give you a credit at closing to cover the cost of the repair. Or, in more serious cases, money from the seller's proceeds can be held in an escrow account by the title company until the repair is completed after you move in. The key is to identify these problems before the property legally becomes yours. The final walkthrough is your last point of leverage. You've wired the money safely. The final walkthrough is perfect. The finish line is in sight. You're now heading to the closing table, a place where you'll be confronted with a stack of paper an inch thick, filled with legal jargon and endless signature lines. What are you actually signing? Which documents truly matter most? We'll break down the most important papers you'll see at the closing table, reveal the hidden fees to watch out for, and explain what happens in those incredible moments right after you finally get the keys. That moment is closer than you think. But before the keys are in your hand, there's one final boss: the closing table. It's a mountain of paperwork designed to make your eyes glaze over. It's intentionally intimidating. But in that stack, a few documents hold all the power. Forget the 50+ pages of disclosures and riders for a second. We're going to focus on the 4 horsemen of your home purchase, the documents that truly define your ownership and your debt. Knowing these inside and out is your shield against last-minute surprises. First and most importantly is the closing disclosure, or the CD. Think of this as the final exam for your mortgage. By federal law, your lender, in this case Rocket Mortgage, must give you this document at least 3 full business days before you are scheduled to close. This 3-day rule is your golden opportunity. It's a mandatory cooling-off period designed to protect you from being rushed into a bad deal at the table. If you don't get it 3 days in advance, you do not have to close. Period. When you open that document, ignore the urge to panic. Go straight to page 1. Here you'll find the loan terms, your interest rate, your monthly principal and interest payment, and whether your loan has any risky features like a prepayment penalty, which with most standard Rocket Mortgage loans it won't. Now, compare this page 1 with the initial loan estimate you got weeks or even months ago. Do the numbers match? Is the interest rate what you locked in? If anything is different, your phone should be in your hand, calling your loan officer immediately. Next, flip to the last page. Look for a line item called Cash to Close. This is it. This is the exact dollar amount you need to bring to the closing, down to the penny. It's the final calculation of your down payment, plus your closing costs, minus any deposits you've already paid. Seeing this number in black and white can be a shock, but understanding how it's calculated is where you gain control. That brings us to the second key document, the promissory note. If the closing disclosure is the exam, the promissory note is the binding contract you sign after you've passed. It's surprisingly simple, often just a few pages long, but it's arguably the most powerful piece of paper you'll sign. This document is your personal IOU to the lender. It contains your solemn promise to repay the loan. It clearly states the total amount you borrowed, the interest rate, the dates your payments are due, and where to send them. It also lays out the grim consequences if you fail to pay. You are making a direct, legally enforceable promise. When you sign this, the debt is officially yours. Third is the deed of trust, or in some states it's simply called a mortgage. People often confuse this with the promissory note, but they do 2 very different things. The note is your promise to pay. The deed of trust is the collateral that backs up that promise. It's the document that says, if I break the promise I made in the note, the lender has the right to take my house through a process called foreclosure. It secures the loan with the property itself. In many states, a deed of trust involves 3 parties: you, the borrower, the lender, and a neutral third party called a trustee. The trustee holds the legal title to the property until you pay off the loan. It's the trust part of the deed of trust. It's the legal teeth behind the whole transaction. And finally, the fourth and most triumphant document, the deed. This is the championship trophy. While the deed of trust secures the loan to the property, the deed itself is what transfers the property to you. This is the legal instrument that officially conveys ownership from the seller to you. Once this document is signed by the seller and delivered to you, you are the owner. It will be publicly recorded at the county courthouse, announcing to the world that this property is now yours. This is the ultimate goal. Now let's talk about what makes up that scary cash to close number. This is where hidden fees can bite you. They hide in plain sight, buried in line items on your closing disclosure. First are the lender fees, often called origination fees. This is how Rocket Mortgage gets paid for processing your loan. It might be a flat fee or a percentage of the loan amount, often around 1%. You might also see points or discount points. These are optional fees you can pay up front to lower your interest rate. It's essentially prepaid interest. You have to do the math to see if paying for points now will save you money in the long run. But the real Wild West of closing costs are the third-party fees. These are costs for services performed by people other than your lender, and Rocket Mortgage has no control over them. But they are required for the transaction. This is where you need to be vigilant. You'll see a fee for the appraisal, which you already know about. A credit report fee. But then comes title services. You'll likely pay for 2 title insurance policies. One is a lender's policy, which is mandatory and protects the lender in case there's a dispute about who owns the property. The other is an owner's policy, which protects you, the buyer. In many states it's optional, but it's financial malpractice to not get it. Protects your equity for as long as you own the home. You'll also see government fees, like recording fees to file the new deed with the county, and transfer taxes, which can be significant depending on your state and city. Then there are the prepaids. This is a huge point of confusion. You'll be asked to prepay a full year of homeowners insurance premiums. You'll also prepay the interest on your mortgage that will accrue from the day you close until the first of the next month. And the biggest one of all, funding your escrow account. An escrow account is like a mandatory savings account managed by your lender. Every month, a portion of your mortgage payment will go into this account to cover your future property taxes and homeowners insurance premiums. At closing, the lender requires you to deposit a cushion into this account, usually several months' worth of those payments, to make sure there's always enough money to pay the bills when they come due. This escrow funding is often the single largest closing cost, and the biggest surprise for unprepared buyers. So you've reviewed the closing disclosure, you understand the documents, you've wired your cash to close, or brought a cashier's check. You sit at a table in a sterile office with your agent, maybe an attorney, and a closing agent known as a notary or an escrow officer. You will proceed to sign your name more times than you thought humanly possible. Your hand will cramp. Your signature will devolve into a meaningless squiggle. But with each signature, you're moving one step closer. After the ink is dry, a few things happen behind the scenes. The closing agent sends the signed package to Rocket Mortgage for a final review. Once they give the green light, they fund the loan, wiring billions of dollars across the country every single day to sellers and title companies. Once the money is confirmed, the new deed is sent to the county to be officially recorded. And in that quiet moment, after the storm of paperwork and the stress of the wire transfer, something magical happens. The seller's agent, or maybe the closing agent, slides a small set of keys across the table. They feel heavier than you expect. They're not just pieces of metal. They're a symbol of every late night, every saved dollar, every document you chase down. They are the key to your future. But what happens a week later? A month later? Your journey with Rocket Mortgage isn't over. It's just transformed. That first mortgage payment isn't what you think it is. And the online portal you'll be using for the next 30 years has tricks and tools you need to know. In the next part, we'll reveal the surprising truth about where your first payment actually goes, how to navigate the Rocket Mortgage online dashboard like a pro, and the single biggest mistake new homeowners make in their first year that can cost them thousands. That first mortgage payment is a landmark moment. You've signed the mountain of paperwork, you've gotten the keys, and now it's real. The first bill arrives. You open it, you look at the number, let's say it's $2,000, and you pay it. You feel a sense of pride, of accomplishment. You're building equity. You're chipping away at that massive loan. But then you log into your Rocket Mortgage account to see the impact you've made, and your heart sinks. You look at your loan balance and it's barely moved. You paid $2,000, but your principal only went down by maybe $400. What on earth just happened? Did they make a mistake? Is this a scam? No. This is the surprising and often shocking reality of a mortgage amortization schedule. And understanding this is the first step to truly mastering your home loan. Think of your mortgage payment as a pie, sliced into 4 pieces. The acronym bankers use is PITI: principal, interest, taxes, and insurance. The last two, taxes and insurance, don't reduce your loan at all. They go into a special savings account called an escrow account, which Rocket Mortgage uses to pay your property taxes and homeowners insurance on your behalf. We'll come back to that because it's critically important. The real battle is between the first 2 slices, principal and interest. Principal is the money that actually pays down your loan balance. It's the part that builds your equity. Interest is the fee you pay the lender for the privilege of borrowing hundreds of thousands of dollars. In the beginning of your loan, that interest slice is enormous, and the principal slice is tiny. Why? Because the interest is calculated based on your outstanding balance. And in the beginning, your balance is at its absolute highest. So on a 30-year, $500,000 loan, that first $2,000 payment might see $1,600 get devoured by interest, leaving only $400 to fight against the principal. Feels unfair. Feels like you're running in place. But this is how virtually every mortgage in America is structured. The loan is front-loaded with interest. But here's the good news. Every single month, as you chip away at that principal, even with that tiny little sliver, your loan balance gets a fraction smaller. The next month, the interest calculated on that slightly smaller balance is a tiny bit less, which means a tiny bit more of your payment goes to principal. And this effect snowballs. Over years, the slices of the pie begin to change. The interest slice shrinks and the principal slice grows until, near the end of your loan, almost your entire payment is pure principal, crushing the remaining balance. The key is understanding this from day one so you're not discouraged. And the best place to see this in action is inside your Rocket Mortgage dashboard. Logging into that dashboard for the first time can feel a little overwhelming, but it's actually your command center for financial freedom. Let's break it down. The first thing you'll see is the main overview. Your current balance, your next payment amount, and the due date. This is your vital signs monitor. The very first thing you should do here is set up autopay. Do not leave this to chance. A single late mortgage payment can drop your credit score by 100 points and stay on your record for 7 years. Set it, forget it, and protect your financial future. Now let's explore the tabs. You'll see a section for Payments or Payment Center. This is more than just a place to pay your bill. This is where the magic happens. Here you'll find an option to make an extra payment. You can add an extra $100 to your regular payment, or you can make a separate payment at any time. But here's the critical part. You must specify that this extra money goes directly toward your principal. The Rocket dashboard makes this easy with a simple checkbox or drop-down menu. Why is this so important? Because every extra dollar you apply directly to the principal is a dollar that you will never pay interest on for the entire remaining life of the loan. It's like a cheat code. Paying just an extra $100 a month on that $500,000 loan could shave years off your mortgage and save you tens of thousands of dollars in interest. Next, find the Documents section. This is your digital filing cabinet. Your closing disclosure, your initial escrow statement, and most importantly, your annual tax and interest statements are all here. Around January or February, you'll need a form called the 1098. This form shows how much mortgage interest you paid the previous year, which is often tax deductible. You don't need to wait for it in the mail. You can download it directly from here. Finally, look for a tool that might be called an amortization schedule or loan details. This is a full, transparent breakdown of every single payment you will ever make for the next 30 years. It will show you month by month how much goes to principal and how much goes to interest. It's the tool that lets you see the future. You can see the exact date your principal payment will finally become larger than your interest payment. You can also use their built-in calculators to see the impact of making those extra payments we just talked about. See for yourself. Plug in an extra $200 a month and watch the payoff date jump forward by years. This dashboard isn't just for making payments, it's for building a strategy. But navigating this dashboard also helps you avoid the single biggest and most financially painful mistake new homeowners make in their first year. It's a mistake that can lead to a sudden, shocking increase in your monthly payment and a bill for thousands of dollars you didn't see coming. It's not about missing a payment. It's about ignoring one crucial document, your annual escrow analysis. Remember that escrow account? Where money for your taxes and insurance is held. When you first closed on your house, Rocket Mortgage estimated how much your property taxes and homeowner's insurance would be for the year. They based this on the previous owner's taxes or data from the county. The problem is, it's just an estimate, a guess. Here's what happens all too often. After you buy the home, the county reassesses the property value. And guess what? It's almost always assessed for more than what the previous owner had, because you just paid a new, higher market price for it. This means your property taxes go up. Sometimes they go up a lot. At the same time, insurance rates might have increased. So for the entire first year, Rocket Mortgage has been collecting the estimated amount from you each month, but when the actual tax and insurance bills come due, they have to pay the real, higher amount. This creates a shortfall, an escrow shortage. At the end of the year, Rocket does an analysis. They see they didn't collect enough money from you over the past 12 months to cover the bills. Let's say the shortfall is $1,200. They also look ahead to the next year and realize they need to collect more each month to cover the new, higher tax and insurance bills. Let's say they need an extra $100 a month for that. So what happens? You get a letter in the mail and a notification on your dashboard. It says you have two options. Option 1. Pay the entire $1,200 shortfall in one lump sum, right now. And by the way, your monthly mortgage payment is also permanently increasing by $100, effective immediately. Option 2. If you can't pay the lump sum, they'll just roll it into your payment. They'll divide that $1,200 shortfall by 12, which is another $100 a month. So your total mortgage payment just jumped from $2,000 to $2,200 a month. A 10% increase out of nowhere. This is the mistake, getting blindsided by this. People see their mortgage payment as fixed, but the T and the I in pity are variable, and they can deliver a knockout punch to your budget if you're not prepared. The solution is to be proactive. In your Rocket Mortgage dashboard, find your escrow details. Look at the estimated annual property tax. Then go to your county assessor's website and see what your new, updated tax bill actually is. If you see a big discrepancy, you can start setting aside extra money now, so when that analysis letter arrives, it's not a panic-inducing crisis. You saw it coming and you prepared for it. You took control. And that feeling of control is what this entire process is really about. It's about moving from a place of uncertainty and anxiety to a position of knowledge and power. The mortgage process, whether with Rocket or anyone else, can feel like you're being pushed along a conveyor belt, with forms and requests flying at you from all directions. But by understanding each step, from pre-approval to the closing table, and even into the years of managing your escrow account, you're no longer just a passenger. You are the pilot. So this brings us to the final 10,000-foot view question, the one we've been building toward this entire time. After everything we've covered, the tech, the people, the process, the pros, the cons, what's the final verdict? Should you, the person watching this right now, use Rocket Mortgage for the biggest purchase of your life? The honest, unfiltered answer is, it depends entirely on who you are. And I know that sounds like a cop-out, but it's the most valuable truth I can give you. Because the best mortgage lender doesn't actually exist. The only thing that exists is the best mortgage lender for you. So let's break down exactly who that is. Let's do the final litmus test. You should seriously, strongly consider Rocket Mortgage. It might be the perfect fit for you if you are a certain type of person. First, the tech-savvy, self-directed buyer. If you live your life through your smartphone, if you prefer a dashboard to a phone call, and if the idea of uploading a pay stub at 11 p.m. in your pajamas sounds like a dream come true, Rocket's platform was built from the ground up for you. Their user interface is, without question, one of the best in the entire industry. It provides clarity and a sense of progress that is deeply reassuring. If you trust technology and want to be in the driver's seat of the document gathering process, Rocket is a powerhouse. Second, the straight-down-the-fairway borrower. If you and your co-borrower are W-2 employees with steady jobs, solid credit scores, and a clear source for your down payment, like a savings account or a 401k loan, you are what the mortgage industry considers a vanilla file. And I mean that as a high compliment. Your financial picture is easy to verify and document. Rocket's system is optimized for exactly this. It's designed to take clean, straightforward applications and process them with incredible speed and efficiency. For you, the experience is likely to be shockingly fast, smooth, and painless. Third, the first-time homebuyer who values guidance and accessibility over a single point of contact. If the thought of walking into a stuffy bank and sitting across a mahogany desk from a loan officer in a suit makes you anxious, Rocket's model can be far more approachable. You can explore scenarios, play with numbers, and even get pre-approved without ever having to speak to a human until you're ready. The process feels less judgmental and more exploratory, which can be a huge comfort when you're just starting out. For these groups, the value proposition is immense. The convenience, the speed, and the clarity of the digital platform often outweigh any potential savings you might find by shopping around at a local credit union. The peace of mind that comes from a smooth, predictable process is worth a premium for many people. However, there's another side to this coin. You should pause, take a deep breath, and seriously explore other options if you fall into a different set of categories. First, the borrower with a complex income story. Are you self-employed? A freelancer? A small business owner? Do you get paid in 1099s, K1s, and commission checks? Is your income a beautiful, chaotic mix of different sources? If so, Rocket's streamlined, algorithm-driven system can sometimes feel like trying to fit a square peg into a round hole. Their process is built for volume and standardization. Complex income requires a human touch. A seasoned loan officer who can look at your 2 years of tax returns, understand the narrative of your business, and present it to an underwriter in a way that makes sense. A local mortgage broker who has seen hundreds of files like yours might be far better equipped to navigate the nuances and advocate on your behalf. Second, the buyer with a story to tell. Maybe you have a past credit issue that you've worked hard to overcome. Maybe your down payment is coming from a complex gift situation involving multiple family members. Maybe you're using non-traditional assets. Anything that requires a human to look beyond the numbers and understand the context of your situation might be better served by a dedicated, local professional. A mortgage broker's entire job is to be your storyteller. to find the right lender and the right program that fits your unique circumstances. That level of bespoke service is not Rocket's core business model. And third, the relationship-driven individual. If you are the type of person who needs one name, one cell phone number, and one person to guide you from start to finish, the Rocket team model might be frustrating for you. While they are highly efficient, you will likely interact with multiple specialists throughout the process, one for origination, another for processing, another for underwriting. If you want to be able to text your loan officer on a Saturday morning with a question about a specific house, or meet them for coffee to go over your closing disclosure line by line, then a local lender or broker is, without a doubt, the better choice for you. You are paying for that dedicated, high-touch service. For these groups, the potential for friction is higher. What one person sees as efficiency, you might experience as being passed around. What one sees as a simple request for documents, you might see as a system that doesn't understand your unique financial life. So what does this all mean? It means that Rocket Mortgage isn't inherently good or bad. It is a tool. It is a massive, powerful, technologically advanced tool that has fundamentally changed the way Americans get home loans. And like any tool, it's incredibly effective for certain jobs, and less so for others. You wouldn't use a sledgehammer to hang a picture frame, and you wouldn't use a tiny screwdriver to break up concrete. The goal of this entire deep dive wasn't to sell you on Rocket. It was to arm you, to give you the schematics for the sledgehammer and the screwdriver, so you can look at your own unique situation, your career, your finances, your personality, your communication style, and choose the right tool for the job with absolute confidence. The journey to homeownership is one of the most significant chapters in anyone's life. It's more than a financial transaction. It's the pursuit of stability, of community, of a place to call your own. The mortgage is the key that unlocks that door. And for too long, the process of getting that key has been shrouded in mystery and confusion, leaving people feeling powerless. But by being here, by watching this, by investing your time to understand the inner workings of this machine, you have taken back that power. You now understand the lingo, the players, the potential pitfalls, and the incredible opportunities. You know what questions to ask. You know what to look for in a loan estimate. You know how to prepare for closing and how to manage your loan for years to come. Whether you choose the digital-first efficiency of Rocket Mortgage, the personalized touch of a local credit union, or the market-spanning expertise of a mortgage broker, you will now enter that process not as a victim of its complexity, but as a master of it. You are ready. Go build your future.